On January 20th, 2026, something happened in Japan's bond market that had not happened in the modern history of global finance. In a single trading session, the yield on Japan's 40-year government bond surged past 4% for the first time since that maturity was introduced. The 30-year bond jumped a quarter point in hours. A move that normally takes months happened before lunch. Traders at the world's largest bond firms stood staring at their screens, unable to process what they were watching. One fund manager at PIMCO, one of the biggest bond investors on earth, said simply, "A quarter point surge in a single session. Let that sink in." Bloomberg called it a crash. The European Business Magazine said it sent shockwaves through global financial markets. And Al Jazeera reported that Japanese government bonds and the yen were on a roller coaster as investors exited Japanese government debt en masse. Within hours, the shockwave crossed the Pacific. The 30-year U.S. Treasury yield spiked to 4.918%. Approaching levels not seen since before the 2008 financial crisis. The 10-year U.S. Treasury jumped 6 basis points. Technology stocks tumbled, and the Federal Reserve took the extraordinary step of contacting currency traders directly, a move that only happens when the system is approaching emergency conditions. U.S. Treasury Secretary Scott Bessent appeared on Fox News and said he anticipated that his Japanese counterparts would begin saying the things that will calm the market down. Think about what that sentence means. The United States Treasury Secretary publicly asked a foreign government to calm bond markets because America's largest creditor was destabilizing them. That was January. It is now April of 2026. And what started in Tokyo has not stopped. It has accelerated. Because Japan is the largest foreign holder of U.S. Treasury securities on the planet. As of November 2025, Japanese entities held $1.2 trillion in American government debt, more than China, more than the United Kingdom, more than any other country. And they are preparing to bring that money home. They are not alone. China's visible treasury holdings have fallen from nearly $1.2 trillion to approximately $618 billion, the lowest level since September 2008. India has been selling to defend the rupee. BRICS nations are, in the words of ING's global head of markets, quietly leaving the treasury market. And central banks across Asia bought over 1,100 tons of gold in 2025 alone, the third consecutive year above 1,000 tons. Building reserves in an asset that is not denominated in dollars cannot be frozen by sanctions and cannot be inflated away. This is not a headline. This is a structural shift in how the world stores wealth. And it is happening right now while the United States is running a $39 trillion national debt, paying over $1 trillion a year in interest alone, and fighting a war in the Middle East that has sent oil past $112 a barrel. Every pillar supporting the treasury market is cracking at the same time. And the biggest buyers are heading for the exit. Now let me explain why this matters so much by walking you through how the treasury market actually works. Because most people think of government bonds as boring, safe background noise. They are the opposite. The U.S. Treasury market is a $30 trillion machine that sets the price of money for the entire planet. When you get a mortgage, that rate is derived from treasury yields. When a corporation borrows money to build a factory, the rate is derived from treasury yields. When a foreign government decides where to park its reserves, it looks at treasury yields. And when the U.S. government funds its military, its social security payments, its infrastructure, every single dollar of that spending is ultimately financed through this market. If the treasury market functions smoothly, the global economy has a foundation. If it seizes up, everything built on top of it collapses. And the mechanism that keeps it functioning is simple. Somebody has to buy the bonds. For decades, that somebody was Asia. The system works in 4 stages, and once you understand them, you will see exactly where we are and why what is coming cannot be stopped by any policy, any speech, or any tweet. Stage 1 is accumulation. This is the period when Asian economies, led by Japan and China, build massive trade surpluses with the United States. America buys their cars, their electronics, their manufactured goods. Dollars flow to Asia. Those dollars need to go somewhere, and the safest, most liquid place to park them is U.S. Treasury securities. So Asian central banks and institutions buy treasuries by the hundreds of billions. This keeps U.S. interest rates low, which keeps American borrowing cheap, which allows Americans to buy more Asian goods. It is a loop, a symbiotic cycle, and for 40 years it worked beautifully. Japan's treasury holdings grew from virtually nothing in the 1980s to over $1.2 trillion by 2020. China's grew from near zero to a peak of $1.3 trillion in 2013. Together, just these 2 countries were financing a significant portion of America's deficit spending. Stage 1 was the golden era, and like all golden eras, it contained the seeds of its own destruction. Stage 2 is saturation. This is when the buyers have accumulated so much American debt that continuing to buy becomes irrational or dangerous. Japan's debt to GDP ratio has reached 236.7%, the highest in the developed world. They have their own fiscal crisis brewing. Their own bond market is now demanding higher yields. Their own central bank has raised rates to 0.75%, the highest since 1995. For the first time in decades, Japanese investors can earn meaningful returns at home instead of sending their capital to America. China's motivations are different, but converge on the same outcome. The trade war, the tariffs that reached 145% on Chinese goods, the freezing of Russian reserves after the Ukraine invasion, all of these have taught Beijing a lesson. Dollar-denominated assets are a weapon that can be turned against you. So China has been systematically diversifying, not with a dramatic dump that would crash the market and hurt their own portfolio, but with a steady, quiet, relentless exit. Their visible holdings have fallen by roughly 50% over the past decade, and the dollars they are selling are being replaced by gold. China's central bank extended its gold buying streak past 15 consecutive months, lifting total reserves above 2,300 tons. Gold now accounts for 8% of China's foreign exchange reserves, up from 5.5% a year ago. They are not rotating from one currency to another. They are rotating from paper to metal, from promises to physics. Stage 3 is the crack. This is when the departure of major buyers begins to show in the market itself. Yields rise because there are fewer buyers to absorb the flood of new supply, and the supply is staggering. The Congressional Budget Office projects a federal deficit of $1.9 trillion for fiscal year 2026, growing to $3.1 trillion by 2036. The OECD projects that global governments and corporations need to borrow $29 trillion from capital markets in 2026, a 17% increase from 2024 levels. The U.S. Treasury must sell enormous quantities of bonds into a market where the biggest historical buyers are reducing their appetite. That mathematical mismatch between supply and demand can only be resolved one way. Prices fall, yields rise, and every American who has a mortgage, a car loan, a student loan, or a credit card feels the pain directly. We are in stage 3 right now. Recent auctions for 2-year, 5-year, and 7-year Treasury notes have gone poorly. Yields spiked. Analysts describe the results as reflecting concerns about investor demand for U.S. debt. The 10-year Treasury yield has been elevated above 4% for months. The 30-year yield has been flirting with 5%. These are not abstract numbers. They are the cost of money for the entire American economy. And they are rising because Asia is stepping back. Stage 4 is the repricing. This is when the market fully adjusts to the new reality that the era of cheap, unlimited Asian financing of American debt is over. This stage has not fully arrived yet, but every indicator suggests it is approaching. Let me prove this pattern with history, because it has happened before, and the precedent is terrifying. The first case is the British pound's loss of reserve currency status. After World War II, Britain owed enormous war debts. Its largest creditors, primarily the United States and Commonwealth nations, held massive sterling reserves. Through the 1950s and 60s, those creditors gradually diversified away from the pound. Not all at once, gradually. Year by year, the share of global reserves held in sterling declined. Britain responded with capital controls, interest rate hikes, and appeals to loyalty. None of it worked. Each time Britain raised rates to attract capital, it slowed its own economy, widening the deficit and making the fiscal position worse. Each capital control pushed investors toward other currencies faster. By 1967, Britain was forced into a humiliating devaluation of the pound from $2.80 to $2.40, a 14% cut that wiped out the purchasing power of every person and institution holding sterling reserves. The structural shift was clear years before the crisis hit. The creditors were leaving. The flow data showed it, but British policymakers convinced themselves that it was temporary, that the creditors had nowhere else to go, that the pound was irreplaceable. They were wrong. The pound went from financing 40% of global trade in 1945 to less than 5% by 1975. An entire empire's financial architecture, dismantled by the steady exit of its creditors. And here is the detail that should make every American investor uncomfortable. The transition from the pound to the dollar as the dominant reserve currency did not happen because of a war or a dramatic crisis. It happened because the creditors slowly, quietly, methodically chose a better option. That process took about 25 years. The decline in the dollar's reserve share has been underway for about 10 years. We are not at the beginning of this story. We are in the middle of it. The second case is far more recent and directly relevant. In August 2024, the Bank of Japan unexpectedly raised rates by 25 basis points. It was a tiny move, but it triggered the largest single-day point decline in the Nikkei in history, a drop of over 12% in one session. The S&P 500 corrected 6% within days. The yen carry trade, estimated at between $350 billion and $1.2 trillion in notional value, began unwinding violently. Investors who had borrowed in yen at near zero rates to buy American stocks, bonds, and real estate suddenly faced margin calls. They had to sell assets, any assets, to cover their positions. The contagion spread across every asset class in a matter of hours. That was caused by a quarter-point rate hike. The Bank of Japan's policy rate is now at 0.75%, the highest since 1995. Markets are pricing a 71% probability of another hike, partly reflecting concerns about rising inflation from higher oil prices amid the ongoing Middle East conflict. The carry trade has not disappeared. It has only partially unwound. And here is the part most analysts miss. The carry trade is not just a hedge fund strategy. Japanese life insurance companies, pension funds, and regional banks have spent decades investing trillions overseas because domestic yields were zero or negative. Those institutions hold an estimated $5 to $7 trillion in foreign assets. When domestic yields become attractive, those institutions do not just stop buying foreign bonds. They actively repatriate. They bring the money home, and every dollar they repatriate is a dollar that was previously supporting the U.S. Treasury market and is now leaving it. This is not speculation. Japan's finance ministry estimated that debt servicing costs are rising sharply as yields stay elevated, and Japanese domestic bond issuance will have to surge in the coming years to fund the government's fiscal promises. Those domestic bonds will compete directly with U.S. Treasuries for Japanese institutional capital, and home always wins. The third case is what happened in January of 2026 itself, the Japan bond crash I described at the opening of this video. Prime Minister Sanae Takaichi announced snap elections scheduled for February 8th and pledged to suspend the 8% consumption tax on food for 2 years. The annual revenue from that tax is roughly 5 trillion yen, the equivalent of about 31.5 billion euros. In a country already carrying 236.7% debt to GDP, the highest in the developed world, the promise of an unfunded tax cut was a match thrown into a room full of gasoline. Bond investors fled. 40-year yields broke records. 30-year yields moved by amounts that traders said they had never seen in their careers. The 20-year Japanese government bond yield surpassed the U.S. equivalent for the first time, an event that would have been considered impossible just 2 years ago. And the shockwave traveled instantly to U.S. Treasuries. Bloomberg described it as a crash. Euronews reported that the U.S. was particularly affected because Japan is the largest foreign holder of their debt. The sell-off in Japanese bonds reverberated through markets overseas, with yields on 30-year U.S. Treasuries rising to their highest level since September. This was not a peripheral event in a distant market. This was the largest creditor of the United States, demonstrating that its own domestic priorities now take precedence over financing American deficits. That is a fundamental shift in the global financial order, and that shift did not reverse after the initial shock subsided. As of early April, Japan's 10-year bond yield sits at 2.39% at all-time highs. Markets are pricing a 71% probability of another Bank of Japan rate hike. The higher Japanese domestic yields go, the less incentive Japanese institutions have to keep their money in America. The math is that simple, and that dangerous. Now let me apply this pattern to the present, step by step, with the latest data. Stage 1, the accumulation. For 40 years, Asia accumulated U.S. Treasuries as a natural byproduct of the trade relationship. Japan reached 1.2 trillion. China peaked at 1.3 trillion. India, South Korea, Taiwan, Singapore all held significant positions. Foreign entities collectively held roughly 8.5 trillion in U.S. Treasury securities, representing about 30% of total outstanding debt. That accumulation phase is over. Check. Stage 2, the saturation. Japan's domestic bond yields have risen to 2.39% on the 10-year, an all-time high. Their 40-year bond yield broke above 4%. Their central bank has raised rates to 0.75%, with markets pricing a 71% chance of further hikes. Japanese institutional investors, who hold an estimated $5 to $7 trillion in foreign assets, can now earn meaningful returns at home for the first time in 2 decades. The incentive to keep money in U.S. Treasuries is eroding month by month. Meanwhile, China's visible holdings have fallen to $618 billion, the lowest since September 2008. Bloomberg reported in February 2026 that Chinese regulators advised their financial institutions to limit their holdings of U.S. Treasuries, not to dump, to limit, to stop buying. UBS noted that even though China's banks are not the largest players, the idea that international investors may be less inclined to buy U.S. Treasuries in the future is getting attention in markets. India has been selling treasuries to fund intervention to support the rupee. BRICS nations collectively are, as ING documented, quietly leaving the treasury market. Verified. Stage 3, the crack. The U.S. national debt crossed $39 trillion in March of 2026, arriving at that milestone less than 5 months after hitting $38 trillion, a pace the Committee for a Responsible Federal Budget called unsustainable. Debt held by the public exceeds $31 trillion. The deficit for fiscal year 2026 is projected at $1.9 trillion. Net interest payments will exceed $1 trillion this fiscal year, nearly triple the $345 billion paid in 2020. And the Peterson Foundation projects the debt will hit $40 trillion before the end of the 2026 calendar year. The supply of bonds is surging. The demand from Asia is shrinking. Recent Treasury auctions have gone poorly. Yields are elevated. The S&P 500 peaked at 7,000 in January and has fallen to approximately 6,500, a decline of about 7%, with the Nasdaq down over 10%. Oil has surged past $112 because of the Iran war and the Strait of Hormuz closure. Inflation measured by personal consumption expenditures sits at 3.8%, preventing the Federal Reserve from cutting rates. The Fed is trapped between fighting inflation and supporting a weakening economy. And the bond market is sending a signal that cannot be ignored. Yields are rising, not because the economy is strong, but because buyers are disappearing. Undeniable. Now here's what makes this moment uniquely dangerous. All of the previous case studies involved one major stress at a time. Britain lost its creditors gradually over decades. The August 2024 Kerry trade shock was a single-rate surprise that was quickly contained. Even the January 2026 Japan crash was a one-week event that authorities managed to stabilize temporarily. What is happening right now is the convergence of all of these pressures simultaneously. Japan is repricing its own bond market while being the largest holder of U.S. debt. China is systematically reducing exposure while building gold reserves. Central banks across Asia and the BRICS bloc are redirecting reserves away from dollar-denominated assets. The U.S. is running the largest peacetime deficits in history while fighting a hot war. Oil prices are elevated due to the Strait of Hormuz closure. The Federal Reserve cannot cut rates because inflation is still running at 3.8%. Each of these pressures alone would be manageable. Together, they create a feedback loop. Higher oil raises inflation. Higher inflation prevents rate cuts. No rate cuts keep yields elevated. Elevated yields make the debt more expensive to service. More expensive debt requires more borrowing. More borrowing requires more bond sales. More bond sales into a market with fewer Asian buyers means yields rise further. And rising yields make Japanese domestic bonds even more attractive relative to U.S. Treasuries, pulling more Japanese capital home. The loop feeds itself, and every week it continues. The exit accelerates. And there's another dimension to this that almost nobody is discussing publicly. The gold accumulation by Asian central banks is not just diversification, it is preparation. Central banks purchased over 1,100 tons of gold in 2025, the third consecutive year above 1,000 tons. The World Gold Council projects purchases of 750 to 850 tons in 2026, still historically exceptional by any standard prior to 2022. China's People's Bank extended its buying streak past 15 consecutive months, lifting reserves above 2,300 tons. India's Reserve Bank has been adding episodically while simultaneously expanding domestic bullion handling and storage capabilities. Poland, Turkey, Kazakhstan, Uzbekistan, and even countries like Guatemala, Indonesia, and Malaysia have entered or returned to the gold market after extended absences. Gold now trades above $4,700 per ounce. Goldman Sachs targets $5,800. JP Morgan forecasts $5,500. UBS sees potential above $6,000. These are not speculative projections. They are the logical consequence of the dynamic I'm describing. When central banks simultaneously sell treasuries and buy gold, they are voting. They are voting against the dollar as the permanent foundation of the global reserve system, not against the dollar as a currency, against the dollar as the only option. And that distinction matters enormously because the U.S. Treasury market has been priced for decades on the assumption that it is the only option. That assumption is breaking. There is also the question of what happens to the $3 trillion private credit market and the $3.7 trillion in private equity locked capital when Treasury yields rise structurally. These markets were built during the flood stage, when interest rates were near zero and capital was essentially free. Higher Treasury yields raised the cost of capital for everything downstream. Private credit funds that loaded portfolios with floating rate loans are now facing defaults projected at 8% by Morgan Stanley and 13% worst case by UBS. Private equity firms cannot exit their investments because the buyers who would normally acquire those companies are facing higher borrowing costs. The connection is direct. Asian central banks reduce treasury purchases. Yields rise. Borrowing costs increase across the economy. Defaults rise. Liquidity freezes. The Treasury market is not separate from these markets. It is the foundation. And when the foundation shifts, everything built on top of it shifts too. Let me address 3 myths that are keeping people frozen in the wrong position. Myth 1. China would never dump treasuries because it would hurt their own holdings. This is true, and it is also irrelevant. Because China is not dumping. They are doing something far more effective. They are slowly exiting while simultaneously building alternatives. They are settling trade in local currencies. 90% of Russia-China trade now uses non-dollar settlement. They are buying gold at unprecedented levels. They are using custodial arrangements through Belgium and Luxembourg to make their true exposure opaque. The Euroclear Bank in Belgium and the Clearstream Depository in Luxembourg sit at the center of cross-border settlement. And when China moves treasury holdings to these custodians, the U.S. data shows a decline in Chinese holdings even if the bonds are still in Chinese hands. And they have reportedly told their banks to limit new purchases. Bloomberg reported in February 2026 that Chinese regulators advised financial institutions against holding large amounts of U.S. treasuries. UBS analyst Paul Donovan noted that even though China's banks are not the largest players, the idea that international investors may be less inclined to buy in the future is getting attention in markets. You do not need to dump when you can simply stop buying and let the bonds mature without replacement. The effect on the market is the same, just slower. And slower gives them time to exit without crashing their own portfolio. A study published in January 2026 by the National Bureau of Economic Research, authored by researchers from Yale, Stanford, and Columbia, concluded that if U.S. debt levels increase significantly, the price impact of a Chinese sell-off could trigger a financial crisis. The debt has increased significantly. It is now $39 trillion and growing at $7 billion a day. Myth 2. Japan will always buy U.S. treasuries because they need the dollar to stay weak for exports. This was true for decades. It is no longer true today. Japan's bond market crash in January demonstrated that domestic fiscal priorities now dominate foreign investment strategy. When your 40-year bond yield breaks 4% and your currency is under pressure and your prime minister is promising unfunded tax cuts, you do not send more money overseas. You bring it home. The Bank of Japan is tightening. Domestic yields are rising. Japanese life insurance companies and pension funds, the traditional mega buyers of U.S. treasuries, are rethinking their allocations for the first time in a generation. Ed Yardeni, president of Yardeni Research, put it simply. Japanese investors in the past have been particularly aggressive in buying debt in other markets, in particular the U.S., where interest rates have been higher than in Japan. Now that their yields are going up, you're likely to see that Japanese bond investors may be more likely to stay home. This is not a temporary disruption. This is a structural regime change in the world's third largest economy. Myth 3. The private sector will fill the gap left by Asian central banks. This is the most dangerous myth of all. ING's Chris Turner noted that the private sector has been willing to buy treasuries in recent periods, but private sector buyers are fundamentally different from central bank buyers. Central banks are price insensitive. They buy for policy reasons, not for returns. They buy during crises when everyone else is selling. They hold for decades. They do not ask for higher yields because they are motivated by trade settlement and currency management, not by profit. Private sector buyers are the opposite. They are price sensitive. They demand higher yields to compensate for risk. They can leave faster. They have shorter time horizons. They panic during crises. Replacing a central bank buyer with a private sector buyer does not stabilize the market. It reprices it. It means permanently higher yields, permanently higher borrowing costs, and permanently higher pressure on every interest rate sensitive sector of the economy, which is essentially the entire economy. Housing, corporate investment, consumer credit, government debt service, all of it gets more expensive when the buyer of last resort becomes a buyer of convenience. So what do you do with this information? Here is what the data, the history, and the pattern all point toward. First, understand that rising treasury yields are not temporary volatility. They are the new structural reality as Asian demand recedes. Every rate-sensitive asset, from real estate to corporate bonds to dividend stocks, is being repriced. The Motley Fool reported that Vanguard says it would take oil at $150 per barrel to trigger a U.S. recession. We are at 112. Goldman Sachs warned that if the Strait of Hormuz remains closed, that threshold could be crossed. Meanwhile, the S&P 500 is down 7% on the year, the Dow is down 8%, and the Nasdaq has fallen more than 10%. Only 28% of S&P 500 stocks are trading above their 50-day moving averages. The index broke below its 200-day moving average on March 19th for the first time in over a year. Position your portfolio for a world where rates stay higher for longer, not because the Fed wants them there, but because the bond market demands it. Second, pay attention to the yen. The yen carried trade, estimated at $1.2 trillion in notional value, is the single largest source of potential forced selling in global markets. When the Bank of Japan raises rates, the yen strengthens. When the yen strengthens, carry trades unwind. When carry trades unwind, assets across the globe are sold to cover positions. The next BOJ rate hike, which markets are pricing at 71% probability, could trigger the same kind of cascading sell-off we saw in August 2024, but potentially larger because yields are starting from a higher base. And here's what makes it worse. The BOJ is in a box. Japanese inflation has hovered above the central bank's 2% target for 4 years. Oil prices are elevated because Japan imports the vast majority of its energy from the Middle East. Rising energy costs feed inflation. Rising inflation demands rate hikes. Rate hikes strengthen the yen. A stronger yen unwinds carry trades. And unwinding carry trades destabilize the very Treasury market that the U.S. depends on for funding. It is a chain reaction, and the first link in the chain is already pulling. Third, watch gold. Central banks are not buying gold because it is shiny. They are buying it because they are preparing for a world where the dollar is no longer the unquestioned reserve asset. Over 1,000 tons purchased in 2025. BRICS plus nations now hold 17.4% of global gold reserves, up from 11.2% in 2019. China's reserves are above 2,300 tons and growing. India, Poland, Turkey, Kazakhstan, Uzbekistan, and even Guatemala and Malaysia are entering or re-entering the gold market. When every major central bank in Asia is buying the same asset while selling the same other asset, that is not noise. That is a signal. Gold has already surged above $4,700 per ounce. The structural demand floor from central bank purchases and Asian physical buying is expected to hold prices above $4,000, even in bearish scenarios. This is not about trading gold for short-term gains. It is about understanding that the institutions who manage sovereign wealth are making a generational bet against dollar-denominated reserves. Fourth, reduce exposure to long-duration bonds. Long-term Treasury bonds are the most vulnerable to the dynamic I have described. If Asian demand continues to decline, long-term yields will rise, and the prices of existing long-term bonds will fall. Institutional investors have already moved $29 billion into short-term government bond funds in March alone, while pulling $3 billion out of long-term bonds. Follow the institutional flow, not the headline narrative. Fifth, diversify internationally. If the U.S. Treasury market is being structurally repriced, then U.S. interest rates will remain higher than the market currently expects, for longer than the market currently expects. That creates opportunities in markets that are not dependent on the same dynamics. Look at where capital is flowing, not where it has been. Sixth, hold more cash than feels comfortable. Cash reserves above 12 months of expenses give you something priceless during a period of rising yields and market stress. They give you optionality, the ability to buy assets at distressed prices rather than being forced to sell them, the ability to wait out volatility rather than capitulate at the bottom. Cash is not a return on investment. It is a return of options. Let me close with the number that matters most. $1 trillion. That is what the United States will pay in interest on its debt this fiscal year. That number was $345 billion just 6 years ago. It has tripled. And every single basis point that yields rise because Asian buyers step back adds billions more to that annual burden. The Peterson Foundation projects that over the next 30 years, the government will spend nearly $100 trillion on interest alone. $100 trillion. That is not a debt that gets repaid. That is a debt that consumes the debtor. For 40 years, Asia financed America's spending. They bought the bonds. They kept rates low. They enabled the deficits. That era is ending. Not in some distant theoretical future, right now. Japan's bond market crashed in January and sent tremors through the global system. China's holdings are at their lowest since 2008. Central banks across the developing world are converting dollar reserves into gold at record pace. The carry trade that sent trillions in Japanese savings into American assets is unwinding, and the U.S. government needs to borrow more than ever, at higher rates, from a shrinking pool of willing lenders. And here's the final piece that ties it all together. Federal Reserve Chair. Jerome Powell's term expires on May 15, 2026. That is roughly 6 weeks away. Kevin Warsh has been nominated to replace him. This transition alone introduces enormous uncertainty into markets that are already fragile. A new Fed chair means a new communication style, new priorities, potentially a new approach to the balance between inflation and employment. Markets hate uncertainty. And this uncertainty arrives at the worst possible moment, when the Treasury market needs stability more than at any time in the past 2 decades. The dollar's share of global foreign exchange reserves has already fallen from roughly 65% in 2016 to approximately 59%. That decline has been absorbed relatively smoothly because it was gradual and because the alternatives were limited. But the alternatives are no longer limited. BRICS plus nations now hold 17.4% of global gold reserves, up from 11.2% in 2019. China has announced plans to serve as custodian for foreign sovereign gold reserves, a direct challenge to the London and New York depositories that have dominated gold custody for over a century. Regional payment systems that bypass dollar settlement are expanding. The architecture of an alternative financial infrastructure is being built, not as a replacement for the dollar, not yet, but as an insurance policy against dollar dominance. And insurance only gets purchased when people believe the risk is real. The math does not work anymore. The buyers are leaving, the yields are rising, the interest payments are compounding, and the people who understand this, the central banks, the sovereign wealth funds, the institutional investors, they are already repositioned. The question is whether you are. If this information changed how you think about your portfolio, your savings, or your financial future, subscribe to this channel and turn on notifications. Because what I have shown you today is not a one-time event. It is a process. It is unfolding in stages. And the next stage will be determined by the Bank of Japan's next rate decision, by China's next reserve allocation report, and by the next Treasury auction that fails to attract enough demand. Each of these events is a data point in a pattern that has been repeating since the British pound lost its reserve status 70 years ago. And the only difference is that this time the stakes are measured in trillions, and the exits are getting crowded. Share this with someone who still thinks Treasury bonds are the safest investment in the world. They need to see what is happening before the market teaches them the hard way.